fundsupermart.com.
After the recent market correction, many investors are seeking a new direction in the current market volatility. With us today is Mr. Trent Koch, Portfolio Manager of First State Global Listed Infrastructure Fund, who will share with us his views. What role does listed infrastructure take in an investment portfolio? Why is it important to have allocation in this sector?
Well, listed infrastructure can play a very important role in clients' portfolios. And there's really three key reasons why clients are allocating today. One, it's the income. Infrastructure provides investors with a very reliable income of around 4% per annum. These are businesses that tend to have very stable, regulated revenue streams, and therefore and because of the free cash flow they generate, they tend to pay out a very reliable income yield of around 4%. The second reason is growth. These are businesses, and it's what we term as structural growth. So it's growth that in many ways is less dependent on the economic cycle. And the third reason, which I guess is very important today, given the volatility you're seeing in markets, is because infrastructure, because of the defensive characteristics, it tends to be less volatile than other asset classes. And historically, we've seen that infrastructure has generally given investors the majority of the upside in rising markets, but importantly, it's protected their capital in down markets.
What is the strategy's investment process? What is the view on the various countries and sectors?
So we have a very much a bottom-up investment process from a universe of around 300 companies around the world that could be considered to be infrastructure. We screen that down to a universe of around 120 companies, and then we build a portfolio from that with around 40 securities or 40 companies that we invest in. We have an investment team of around 8 people, and it's our job to meet and to research and do a lot of fundamental research to really understand the drivers of these companies. And as I say, we build a portfolio from the bottom up, which invests across all markets and countries. With regards to our views on countries and sectors, we tend to favour developed countries when investing in infrastructure. The number one risk for us when investing in this asset class is the political, the legal and the regulatory risks. And for us, those views just tend to be much higher in emerging markets. With regards to sectors, today we're a bit more cautious. Some of the income sectors that have been, such as regulated utilities, some of the airports, some energy pipelines, the valuations for us today, we feel are stretched in some of these parts of the markets. And we've been favouring the growth infrastructure companies such as toll roads, ports, communications towers and so on.
What is your team structure like, and how often do you conduct company visits?
So we have a team of 8 dedicated investment professionals, all based in Sydney in Australia. We've been together now for close to 8 years, and on average, the average investment experience for each individual is around 15 years. We've come from infrastructure backgrounds. Myself, I've been working and investing in infrastructure for close to 15 years. And for us, it's really important to build a team of specialists that have a deep understanding of this asset class. With regards to our process and the research that we conduct, it's very much a focus on bottom-up research. We spend a lot of time out of the office meeting with the companies that we invest in, meeting with companies that we may look to invest in as well. As an example, just later this afternoon, I'm meeting here in Hong Kong with one of the companies in our portfolio. It's a company, China Merchants Holdings, one of the largest port companies in the world, and I'll be spending time with the management team there. Again, it's a management team we've met with many times, but it's important for us to get in front of them regularly and to ensure that we are close to what's happening within that business.
What is your view on global infrastructure sector for 2015 and 16?
Well, infrastructure companies tend to be very stable. They tend to provide very defensive cash flows through the cycle. And so our view in current markets remains very much the same because many of these businesses are either regulated or have long-term contracts in place. There's good stability in their earnings. So today within our portfolio, we're forecasting dividend yields of around 4% for the companies we invest in, and earnings growth of 5 to 6% on top of that. So our outlook for the asset class remains positive over the longer term. Yes, there will be volatility in markets, as we've seen in recent months, and we expect that volatility to remain in the near term. Concerns around interest rates going up in the US will continue to weigh heavily on markets. Concerns around growth in China and in other parts of our universe will also continue to weigh on markets. But because these businesses provide good income, they've got real structural growth stories, and because of the defensive cash flows they have, they tend to be less volatile in markets. We believe that this is an asset class that can play an important role in clients' portfolios.